Oh man. Oh man. Oh man. You did pimp me. You pimped me hard today. I bought some silver like you said and I got my face completely ripped off. Pulled all the way back to the white meat. You jerk pimp moron. You're a jerk. You're a super jerk. A big fat pimp super jerk. A big fat pimp of a jerk. I hate you. Don't hate me, player, hate the game. You got in at the top of the trading range. You were aware of the risk. There is risk of loss in trading stocks. There is risk of loss in trading commodity futures. There is risk of loss in trading options on stocks and options on commodity futures. Stop being a whiny baby. Grow up and take it like a man, you tiny little wimp. Man up. But you said that the precious metals were in a bull market and that I should be a buyer. You told me to go long the market. I did, and now I am sorry that I listened to you. Calm down. Get a hold of yourself, dude. Just because the precious metals are in an uptrend does not mean that the market won't pull back. Prices go up and down. No need to cry like a little girl just because you can tolerate the initial drawdown. Man up. Be a pirate. Did you see the Fed chairman cry when he stole America's tax money? Did you see him cry when he mortgaged our children's future? You got into the market too late and you know it. Had you got into the trade when I told you to, you would be in the money and this drawdown today would be nothing but noise. No. Nope. I disagree. You're pimping me. Mr. Market is pimping me. I don't like being played. I don't like being pimped. Okay, I see what you mean, but let's review what happened today so that we can gain a better understanding of what happened in the market. The first thing to realize is that we experienced a gap up on the open, or a breakaway gap. When trading the breakaway gap, your entry point risk is greater than had you entered at the beginning of the move. That is the risk you run when you trade the gap. If the market gaps up above your entry price, you're taking a greater risk that the market will top out against your position. The stop and reverse trigger is recommended as a volatility stop loss. Its purpose is to allow you to ride out periods of volatility in a given market. You must be prepared to ride it out. Another suggestion would be to place your initial stop loss at the support low trigger. The support low trigger is also located on the spreadsheet along with stop and reverse trigger. Okay, so let me see if I understand what you are saying. Are you suggesting that I use the stop and reverse trigger as my initial stop loss? Or at least use the support low as my initial stop loss? Yes, that is correct. I would prefer that you get into the habit of using the stop and reverse trigger as your initial stop loss. It is important to understand that during periods of extreme volatility you must protect yourself with the appropriate stop loss. You need to be able to hold the position without getting stopped out prematurely. Yeah, but according to the spreadsheet, that initial stop loss is very wide, and looking at the GQ ETF, the stop and reverse is $10 away from my entry price. I will get killed if I got stopped out at that price. My face would be completely ripped off. I would blow up. My account would simply blow up. I would be destroyed. I hate this pimperation. Pimperation. Yes, it is pimperation. However, I do not want you to be discouraged. You see, when it's a bull market, everybody is a genius. Everyone thinks that they know what they are talking about. They say things like, "The market will never go down," or "The Fed won't let the market go down," or "Too many people are buying this market so it won't go down," or "Even if this market goes down, I will just hold my position because it will just go back up." Every time this market falls, people just buy IT back up. This kind of talk is prevalent during extreme market craziness. Nobody thinks that IT can go down. That's when Mr. Market lays the pimp hand down and smacks the tar out of people until they, like you say, blow up their account. Oh, I see. So I was wrong to blame you for today's price action in the precious metals market. Instead, I should be focused on managing my position and concentrate on sound money management and risk control. So then let me ask you something. How do I control my losses and avoid being a complete idiot? How do I avoid being an idiot? Use stops. You avoid being an idiot by placing stop losses on your trades. By placing stops, you take the emotions out of the trade. Like my man Oscar says, stops are and emotions are out. Okay, I get it now. I must use stops when trading equities and futures and Forex. That is correct. So in our next video we will explore more trading strategies and techniques that you can use straight from the spreadsheet. So be encouraged. Don't let silver get you down. Silver is still in a bull market. So all those $28 April 2011 call options, you were still in the money on those.